Hi guys, welcome back to my channel. Kelvin here. As you can see here, we have managed to invite another pretty girl onto my channel. Her name is Hazel. She's from the Joyful Investors, where she talks about investing and personal finance on her YouTube channel and her blog. So Hazel, can you give us a quick intro about yourself?
Hi everyone, I'm Hazel. I run a YouTube channel called The Joyful Investors together with my other partner to document on our investing journey and also to share some of the investing principles that we adopt ourselves. Right. So then on top of filming videos, we also write as well. So we maintain our own blog and we also maintain our own Telegram channel where we will post out these articles that we have written that share about our viewpoints on the recent market happenings. Yeah. So in short, we hope that through our content we can help more investors to make better and more informed investing decisions by learning to understand how the financial markets really work.
Right. So one thing that I noticed about your channel is that you call yourself the Joyful Investors. Where does the name come from?
Okay, so how we came up with this name is that most of the time investors are caught up with emotions like fear, regrets, worries, or stress, especially when there is a bear market.
Right.
Yeah. So but I feel that actually such emotional anguish, they are sometimes due to a lack of understanding of how the financial markets truly work and also what investors can or should do in the markets itself, right? Because in the stock markets, as investors, what we can do is to learn to manage what the stock market throws at us. We can't choose what the stock market throws at us, right? So the only thing we can do is to learn to strategize on our next move under the various situation. Which is why I always say there is no good market or a bad market, but it is the kind of actions that you take that will either lead to a good outcome or a bad outcome.
Right.
So maybe many people will think that a bear market is a bad market. But if we learn to tap on opportunities, right, then it can also lead to a good outcome.
Right.
So I believe it is this kind of mindset and mentality which can help to bridge that gap between investing and staying joyful in the process. And that is the kind of direction that we are actually heading towards. Right? That's why we call ourselves the Joyful Investors. Because we hope that through our content, we can help to break down all the complex stuff into simpler, more digestible pieces. Because the good thing in life is that when things are more digestible, it becomes more executable, right?
Right.
And that's how people can then start to enjoy the process. Yeah. So that's why we call ourselves the Joyful Investors.
So when times are good, everyone is happy, everyone is joyful. But like you said, when times are bad, like right now, where there's a bad market coming, there's inflation, interest hike, there's a war, everything.
Yes.
How are you able to remain joyful during this period?
Okay, good question. I think the key lies in the expectations that we set for ourselves. I find that one of the biggest reasons why some investors may get very stressed out in the process is that there is a mismatch of the expectations that they set with what happens in the reality.
Right.
Yeah. So actually, because of the US market, it actually rallied up a lot in 2021, right? And we also saw how during the COVID crash in 2020, how quick the recovery was. And I think all this kind of perhaps paint a wrong picture of how the stock market is really like. So the first thing is really expectations, setting realistic expectations. So how we can continue to stay joyful in this process is that we need to understand that market pullbacks or even market crashes, they are just part and parcel of our investing journey. Right. So what we are currently experiencing right now, it is something which we have to be mentally prepared to face. So that is the first thing, setting the right expectations. Then the second thing I would say is the approach that we take to invest in the markets. Right? So I don't invest based on macroeconomic factors. I invest based on the long-term fundamentals of the businesses. Right? No doubt, short-term wise, all these economic changes, it might have some impact on the earnings for the next few quarters for certain businesses. But for me, that is not my main focus. My focus is the impact on the long-term fundamentals of the businesses. Right. So for example, if you look at companies like say Coca-Cola, which is we all know is one of Warren Buffett's favorite stock. Yeah. So with high inflation right now, do we think that consumers are going to stop consuming Coca-Cola over the next 10 years?
Yeah, definitely not.
Yeah, so if the answer to such question is actually no, then even if in the impact, right, in the short term wise, even if there is impact on the next couple of quarters earnings, then it doesn't really matter that much for me. So for us, we actually look at what matter more over the longer term.
Right.
Yeah.
So just to add on, what we often forget is that the S&P 500 has always gave like 10% annualized return over the long term. And if you just look at the short term, it's a downwards trend. But if you drag all the way out over 100 years, it's a upward trend.
Yes, yeah, right.
At least for US stock market.
Yeah.
So I would say if you are that worried, just look at the big picture and you will see that you are still doing alright right now.
Yeah, I think the key is really looking at the bigger picture. Yeah.
So moving on, from what I understand, you are currently invested in US, Singapore, and China markets.
Yes.
How's the portfolio doing now?
Right, so if we talk about US wise, I think all the sectors are getting hit except for energy sector right now.
Right.
Yeah, so if we build a stocks portfolio that has exposure to any of the sectors except for energy, chances are our stocks portfolio would have seen some drawdowns. And the same goes for our TGI portfolio as well. Yeah. But I think the key is understanding that if you invest in quality businesses, then eventually you'll be rewarded. So for us, our US portfolio, we are mainly in the technology sector and the consumer discretionary sector, which are actually now out of favor.
Yeah.
Right, but they are also the sectors which tend to outperform the S&P 500 over the longer term.
Right.
So like what you mentioned earlier, look at the bigger picture. Yeah. Then for China tech stocks wise, yes, we are still holding on to our China tech stocks. Yes, and our conviction has not changed. And there's no denying that, like many other investors, right, because of this China tech positions, it is pulling down our portfolio as well. Yeah, but I think if we learn to stay patient and if we learn to actually build our stocks portfolio with good businesses, that eventually we will be rewarded, right? So all these will eventually pass and you will see your stocks portfolio going back up again, right? If we build a portfolio with good businesses. As for Singapore portfolio wise, I would say that the performances for Singapore REITs are rather mixed. Yeah, so our positions in the hospitality REIT sector now, for this year to date, it is doing better than the other REIT sector. Yeah,
Yes.
but then again, we shouldn't be measuring performances like this because hospitality sector, it did well this year, but it underperformed last year and the year before. Yeah, so we shouldn't be looking at performances like this. And for us, the whole primary objective of investing in REITs is to collect the dividends. So we're not that concerned with the current short-term fluctuations. Yeah.
Speaking of fluctuations, when times are good, everyone is like stocks. But when times are bad, like this year,
Yes.
how are you able to stay calm despite seeing your portfolio going down rate day after day?
Okay. I must say that I'm still a human being, so I can't possibly shoot away 100% of all my emotions. But when we talk about staying calm or even staying joyful, it doesn't require us to really be totally emotionless towards our paper gains. What it entails is that we stay mostly and largely on the rational side most of the time. So earlier on, I mentioned about setting realistic expectations, and also the way that I invest is based on long-term fundamentals, right? So these two actually, they are really ways that help me to stay calm because they help me to rationalize in the stock markets itself. Then on top of this, on certain days where I feel exceptionally down or exceptionally affected by all the numbers, right, in my portfolio, then what I will do is I'll just switch them off. Yeah, and just spend the night doing other things. Yeah, so that's a way that works for me. So I guess we all have to find a way that works for all of us. Then on top of that, I think there's one thing which I really find very distracting, which is the notifications from many of the investing apps, the finance news media apps.
Right.
Yeah, that tell you, like how many points Dow Jones tumbled that day, or Nasdaq had the worst week in don't know how many months and all that. Yeah, things like this, and the kind of language, the wording that finance media use, usually they tend to evoke stronger emotions in us. And they might even use imagery like a very stressed-looking Wall Street trader.
That's the same guy that appeared every time.
Yes. So all this actually unknowingly, right, they contribute to that build-up of all the extreme emotions in us. So if we find that actually all these are affecting you, distracting you, then just turn them off.
Right.
Yeah. But most importantly, at the end of the day, is we shouldn't be investing money that we need for near-term consumption. And don't over leverage, right? Yeah, because during the good times, all is good. But when the markets start coming down, or during even bear markets, that is when we have to go through all this emotional turmoil if we are actually investing money that we can't afford to invest.
Yeah, so I think Warren Buffett had this quote, right? Do not invest whatever you're not comfortable holding in maybe 10 minutes. Yeah, just invest what you're comfortable holding for a long term, and you'll be fine. So back to the joyful investors. You guys are using something called the Moneyball investing methodology. Can you share what's that about?
Okay, so our Moneyball investing methodology, it is built upon the idea of making the best returns using our limited capital ideally. So this idea actually originated from a true story of how a baseball manager, he managed to build a winning baseball team despite having the constraint of limited payroll. So how he did that was he made use of statistics and probabilities. Right? So this was a true story, and then they remake it into a movie called Moneyball. Yeah. So when we are looking at good players with good stats, right, they are usually very expensive to recruit onto the team. For baseball, even for other sports like soccer as well.
Right.
Yeah. So the problem for this baseball manager is that he had to build a winning baseball team, but he only had very limited funds to work with. So how he got around this is that he went to analyze all the different players, and he screened out all those good players that have potential. In terms of probabilities and statistics, there is still a high probability of doing well. But the key thing is they are currently unfavored, unloved by other baseball teams.
Right.
So that's how this baseball manager eventually could recruit all these players at a lower price tag, because they are players that are being unfavored right now. Yeah. So we found that actually such principles can also be applied to investing as well, to portfolio management. Yeah. So for us, the first step of Moneyball methodology is to first analyze the fundamentals. Then we will identify quality businesses that we want to invest in. We want to put our money into. Then the second step is to actually identify when should I buy or when should I sell all these quality businesses by looking at the real-time charts. So we look at the technical setups. Yeah. So the whole idea is that we're actually trying to exploit the market inefficiencies that are surrounding all these quality businesses. Because for us today, if you talk about a good investment, it is not just about buying the right stock.
Right.
It is also about paying a good price for the right stock. So we want to ideally buy them when there is a considerable margin of safety on the technical charts. So that is the whole idea of how our Moneyball investing methodology works. Then on top of that, we also try to top up with other analysis, like for example, deciphering what the market makers or so-called big boys are doing, because they are the ones that can cause very huge swings in the markets.
Right.
Yeah, and that is because we understand that in a stock market, how are stock prices derived? The stock prices, it is a product of the collective actions of different market participants. And retail investors like us, we are not the only ones in the market. Yeah, so that's the general idea of how our Moneyball methodology works.
This method sort of remind me the same method which the fund managers are using when they sell old value stocks and try to buy back when it's cheaper. Can you share an example of your most recent trade? Like what made you buy that stock?
Okay. I think it's a very good point that you raised out on the fund managers part, and I think I would like to explain this a little bit further as well. So on first glance, it may seem that what we are doing is very, very similar to what fund managers are doing. But what we have to understand is that what makes retail investors different from fund managers is that for us, we don't have restrictions that fund managers have. And the good thing about this is that it can actually become an added edge for individual investors.
Yeah.
So for individual investors, who do we have to be responsible to?
Ourselves.
Yes, because it is our own money, right? So we only have to be accountable to ourselves. But for fund managers, they have to operate within a certain set of rules. They have certain short-term targets that they have to meet. They have to always ensure that they can deliver results. So because of that, their hands are actually pretty tight. Certain things they can't do, like they cannot hold more cash, things like that. And they are very short-term focused because they need to ensure they deliver results. So for example, if today, let's say there is a stock, right, that is it's a good stock, it's a good business, but the catalyst for its outperformance is further into the longer term. So then in that case, for fund managers, they may not want to be adding such a stock in their portfolio because they can't wait, you see. They have to always meet their targets. But the story will be different for retail investors really, right? Because today we don't have such restrictions. We don't have to force ourselves to say that I must deliver results every quarter. Yeah. So back to your original question on the recent trade, right? So one of the most recent stock positions that we added is for Adobe. And why we added it is because we believe that it's a very strong company. It has already proven itself with very strong financials and performances over the years. And it is still growing. Yeah. Then technical wise, it's currently being beaten down because of all this inflation rate hikes narrative. So on the technical setup wise, there is a good risk to reward ratio. So which was why we added positions of Adobe. Yeah. But of course we can't predict, how long it's going to take for the prices of Adobe to go back up again to its all-time high. Yeah. But the fact that we can't predict whether it's going to take weeks or months to recover does not deter us from adding positions of Adobe into our portfolio. So again, this also kind of linked back to the fund manager thing that I talked about. So for us, we don't have such restrictions, so we are all right because we are long-term investors. So our motivation is that we want to perform well sustainably over longer term.
Okay.
Right. So when the motivations are different, then the way we go about constructing the portfolio would then be very different really. Yeah.
One of your strategy involves trying to buy low and sell high when it's overvalued. But according to Warren Buffett, his strategy is to buy and hold over the long term and never try to time the market. Does this Moneyball strategy sort of goes against that kind of advice?
So indeed, we are not fans of buy and hold. And how our Moneyball methodology came about is also because we believe that we can try to make sense of the markets and try to exploit the market inefficiencies. But having said that, the advice of pure buy and hold over a long term, there's nothing wrong with it, right? And most investors would actually do well from this advice as well if they are not that interested in understanding how the stock prices move, right? Understanding the stock price movements. But perhaps something that I would like to share a little bit more is that contrary to what some investors think about timing the market, some think that timing the market is about guessing. It's just a guessing work or just a pure luck work. Yeah. But for us, when we do our Moneyball strategy, it's not to guess. It is for us to make more educated moves and decisions in the markets so that we can try to increase the probability of our upside potential and then lower the probabilities of the downside risk. Because, for example, when we buy, we only buy when the risk to reward is working in our favor, it's tilting in our favor. Yeah, so that's one part that I would also like to add on. Yeah.
How do you normally do your research? Like for me, not for me, for many investors, they try to see what others are recommending about the stock, and they will buy the stock based on popularity. But for you specifically, how do you normally do your research?
Okay, so I will have criteria set up first. So factors that I think are important for me to look at and analyze the businesses. Then after which it actually becomes a very systematic process. Whereby it's just you have a list of criteria and you try to tick through the list to see whether this business that you are thinking of investing today meets that criteria. Or if any criteria don't meet, then is there a legitimate reason behind why this is happening? Yeah. And one thing that I often talk about is that don't confuse reading the news as doing your research, right? Because there are lots of news coming out every day, and we have to understand that a company will always have new developments day in and out, right? But does that mean that the fundamentals are going to change every day? Not necessarily. Yeah, and especially because for us, I would say that the criteria that we set out is rather stringent to begin with. So which means to say we only would prefer to invest in businesses that have already showcased a track record of good performances.
Right.
So fundamentals, they don't just change or worsen immediately within just a short span of time. which is why I always say that no, don't get too caught up with reading the news, because a lot of times, to me, many of those are actually just noises. Actually, yeah.
So, do you have Tesla in your portfolio?
Currently, no.
Alright, so yeah, because you consider it as overvalued in a way, right? So you are waiting for it to go back down to a more cheaper price so that you can buy back in. Yeah. So for me, I have a lot of Tesla stocks in my portfolio. Do you have any advice for me? Like, what should I do to improve that kind of portfolio?
I have no advice for you. I believe that you have constructed your portfolio that way because you have done your research. You have a certain level of conviction in it, and it is the kind of allocation that you feel comfortable with. Yeah, I think that's very important for every investor because everyone is different, right? So we have to find one whereby we are the most comfortable with. Because there is always this question of how diversified or how concentrated we should be, but there is never an answer that fits everyone.
Right.
So perhaps instead of giving you advice, I would share with you more on how I would do it myself for my own style. So when we analyze businesses, right, we would typically look at whether the business has a customer concentration risk, whereby it only has one major or two major customers. Because we don't want businesses like that. Because if anything happened to those customers, then the business is in huge trouble. So bring that same train of thought and logic into portfolio construction. Today, I also don't want my portfolio to be just one company. I would prefer to have a number of names in my portfolio. But having said that, I wouldn't restrict myself to like a fixed allocation percentage.
Right.
That means I don't need it to be like, okay, every stock name only 5% or 8% or 10%. Yeah. So at any one point in time, I might be more concentrated in a particular sector or a particular market. So it all depends on the market opportunities. So it is more flexible in that way. So this is my style of how I will go about building my portfolio. Yeah, but we all got to find a way which we are most comfortable with.
Yeah, because I think it's personal finance. So
yeah,
it's personal.
Yes.
Everyone has a different style. I think that there's no right or wrong. Just go with what you are comfortable with. I think that's the most important.
Yeah, must be able to sleep well at night.
Yeah, that's the most important thing besides earning money.
Yes.
Okay, so for the final question, do you have any advice for investors how to invest right now, especially given the current market condition?
I would say it is to know what you own and why you own it. Because there are many ways that we can make money in the stock markets, whether it's through income investing, growth investing, value investing, trading, or more, right? But at the end of the day, the most important thing is to understand what you sign up for and then set realistic expectations that align with what you sign yourself up for. Yeah, because this is important in order to have the conviction to continue to stay invested in the stock markets, even during times when markets are not doing well, or even during times when there is a bear market, because eventually there will be a bear market that comes. Yeah.
In summary, just invest for the long term and you will do well.
Yes.
Yeah. Okay, we have come to the end of this interview. Thank you, Hazel, for joining us.
Thank you, Kelvin.
Yeah, if you have not subscribed to her yet, do subscribe to her. Her content is actually quite good.
Thanks for inviting me.
Okay, so bye.
Bye bye.